Have you ever had that sinking feeling around late January when you realize the UK self-assessment tax deadline is literally days away, and you might have just overpaid the government thousands of pounds because you didn't know a few basic hacks? Yeah. Been there. And trust me, it's not fun. So today, I want to walk you through every single UK tax hack that investors need to know before January 31st, the stuff that separates the smart investors who keep more of their gains from the ones who basically hand HMRC a tip every year. This isn't one of those 5 quick tips videos with recycled advice. We're going deep. Stocks, crypto, ISAs, pensions, property income, dividend strategies, even how to make the most of tax loss harvesting before the clock runs out. And by the end, you'll not only understand how to optimize your portfolio for tax efficiency, but you'll also see how to legally keep more money working for you instead of the government. Let's get into it. 1. The first rule: the 31st of January isn't just a deadline, it's a strategy date. Most people treat the 31st of January as the last day to panic. But smart investors treat it as the day they finish optimizing. Here's the truth: the UK tax system runs on a weird hybrid calendar. The tax year runs from the 6th of April to the 5th of April, but the self-assessment deadline for paying and filing is the following the 31st of January. That gap, from April to January, is pure gold. It gives you time to fine-tune everything, claim reliefs, offset losses, and shift your money around to lower your tax bill. And most investors don't use it. So, before we even get into specific hacks, make sure you're tracking everything now. Don't wait for HMRC's Pay Now reminder. Use a tool like FreeAgent, QuickBooks, or even MoneyHub to connect your accounts and track income streams, dividends, capital gains, property income, and so on. The reason is simple: if you don't know your numbers, you can't optimize your taxes. And that brings us to the biggest area investors lose money every single year. 2. Max out your ISA allowance, because it's free money disguised as a deadline. This one sounds basic, but most people don't fully use it. In the UK, you can invest up to £20,000 per tax year in an ISA, whether that's a stocks and shares ISA, cash ISA, or an innovative finance ISA for peer-to-peer lending. The best part? All your capital gains, dividends, and interest inside that ISA are completely tax-free. Forever. No CGT. No dividend tax. No income tax. Nothing. So when investors complain about paying 20% or 40% on their gains, it's often because they didn't move money into an ISA before the tax year ended. But here's the hack, and this is where most people miss out. You can transfer an existing portfolio, say, your general investment account with free trade, eToro, or Hargreaves Lansdown, into an ISA. You'll just need to do a bed and ISA transfer. What happens is, your investments are sold in your taxable account, and then immediately rebought inside your ISA. You pay capital gains tax only on any profits above your allowance during that process, but going forward, everything inside the ISA grows tax-free. And if you're a couple? You can double that benefit, £20,000 each. That's £40,000 a year shielded from tax. Platforms like Moneyfarm, Nutmeg, and Hargreaves Lansdown make it super easy to max out your ISA automatically each month so you never forget. 3. The capital gains tax, CGT, allowance trick: use it or lose it. Here's where things get serious. The capital gains tax, CGT, allowance in the UK used to be quite generous, £12,300 just a couple of years ago. But from April 2024, it dropped to £3,000. That's brutal. It means if you sell shares, crypto, or property outside of your main home, you only get £3,000 in profit before the taxman steps in. Now, here's the hack, and it's time sensitive. If you've got investment sitting on gains right now, consider realizing some of those profits before the 5th of April. Because once the new tax year starts, your £3,000 reset happens and you lose any unused allowance. In other words, it's use it or lose it. And here's a pro move: if you're married or in a civil partnership, you can transfer assets between you tax-free. So if one of you hasn't used their CGT allowance, move some assets over before selling. That way, you double your allowance to £6,000. You can do this easily through most brokers like Interactive Investor or AJ Bell. Just make sure the transfer is a genuine gift, not part of a sale, so HMRC doesn't flag it. For tax loss harvesting, the UK version. In the US, tax loss harvesting is a massive deal. But in the UK? Hardly anyone talks about it. Here's how it works. Let's say you bought £10,000 worth of shares in a company that's now worth £6,000. You're sitting on a £4,000 loss. Instead of ignoring it, sell it, realize that loss, and use it to offset any capital gains you've made this year. So, if you sold another investment for a £4,000 profit, they cancel each other out. No CGT. And if your losses are bigger than your gains, you can even carry them forward indefinitely. Just make sure you report them to HMRC on your self-assessment return by the 31st of January. Here's a small hack that most people miss. If you still believe in the investment you just sold, wait 30 days and buy it back. That's because of the bed and breakfast rule. HMRC ignores a sale and repurchase of the same stock within 30 days. But if you buy it back after 30 days, the loss sticks. Some investors even use alternative funds during that 30-day period, like switching from Vanguard FTSE 100 to iShares Core FTSE 100 to keep exposure but still lock in the tax benefit. 5. Dividends, the hidden tax trap most investors miss. Let's talk about dividends, because this is one area that stings a lot of UK investors. In 2023-24, the dividend allowance dropped from £2,000 to £500. And from 2024-25, it's going down to £500 again, which means almost any dividend income outside an ISA or pension is taxable. If you own dividend-paying ETFs, REITs, or UK shares outside a tax wrapper, this can quietly cost you hundreds a year. So here's the move. Either keep all your dividend-yielding investments inside your ISA or pension. Or if you run a limited company, take advantage of dividend splitting between shareholders, like a spouse. That way, you can use two separate dividend allowances and two sets of lower tax bands. If you're investing through your business, software like FreeAgent or Xero can automatically track dividends and tell you how much of that is taxable vs tax-free. It's boring admin work, but the kind that saves you thousands over time. 6. Pension contributions, the ultimate tax cheat code. This is where the rich quietly win. Pension contributions are the most tax-efficient way to invest in the UK, and most people don't take full advantage. You can contribute up to 100% of your earnings, or £60,000, whichever is lower, to your pension and get tax relief on it. That means if you're a higher rate taxpayer, 40%, you only pay £60 for every £100 that goes into your pension. The government adds the other £40 back through tax relief. That's an instant 66% return on your money, before your investments even start growing. And if you're self-employed or running a limited company, you can make employer contributions instead of personal ones. These count as a business expense, which means they reduce your company's corporation tax. So if your company's making £80,000 in profit and you pay £20,000 into your pension, you've just saved £4,000 in corporation tax, assuming 20%. This is one of the cleanest, most powerful tax strategies, but it only works if you do it before the 5th of April, not after. You can use providers like PensionBee, Interactive Investor, or AJ Bell to set it up in minutes. 7. Advanced UK investor tax hacks that most people never use. Now that we've covered the essentials, ISAs, CGT, pensions, and dividend traps, let's move into the advanced level. This is where investors who know the system play chess while everyone else is still learning checkers. We're talking VCTs, EIS, SICE, and some surprisingly legal ways to invest in property and crypto while still staying tax efficient. 7.1. VCTs, Venture Capital Trusts tax relief for the brave. Most investors have never touched a venture capital trust, and honestly, that's fair. They sound complicated. But if you understand them, they're one of the most generous tax-saving vehicles available to UK investors. Here's the deal. A venture capital trust, VCT, is basically a publicly listed fund that invests in small, early-stage UK businesses. They're high risk, but they come with some serious tax incentives. 30% income tax relief on investments up to £200,000 per year. Tax-free dividends from the VCT. No capital gains tax when you sell your VCT shares. Example: if you invest £10,000 in a VCT, you can get £3,000 back as income tax relief, as long as you hold the shares for at least 5 years. This isn't a loophole. It's how the government incentivizes investors to fund UK startups instead of just chasing FTSE or US stocks. You'll find VCTs managed by firms like Octopus Investments, Amati, and Foresight, and while you should absolutely read the fine print and the risk section twice, these can be gold for higher-rate taxpayers looking to reduce income tax and diversify. 7.2. EIS and SICE, the Entrepreneur's Tax Shelter. If you want even bigger tax relief, and you're okay with a little more risk, then the Enterprise Investment Scheme, EIS, and Seed Enterprise Investment Scheme, SICE, are worth a look. Here's how they work. You invest directly in a small qualifying UK company, and the government gives you back 30% income tax relief, EIS, or 50%, SICE. No CGT on any profits if you hold for 3+ years. CGT deferral if you roll gains into an EIS investment. Loss relief if the company fails, so even if it tanks, you can claim part of the loss against your income tax. Example: let's say you invest £20,000 into an SICE-eligible startup and the business fails. If you're a 40% taxpayer, you could reclaim £10,000, 50% SICE relief, plus up to 40% of the remaining £10,000 loss against your income. So your total downside might be only around £4,000, even though you invested £20,000. You can find EIS opportunities through platforms like Syndicate Room, Crowdcube, or Cedras, which make the process easy and transparent. These aren't for everyone, but if you're in a high tax bracket and already maxing out your ISA and pension, this is how smart investors layer in government-backed tax reliefs. 8. Property investors, the forgotten tax efficiency moves. Alright, let's switch gears for a second. Property investors often assume there's no way to reduce taxes beyond don't make too much profit. But that's completely wrong. Here's how you can still optimize your property portfolio before January 31st. 8.1. Claim every allowable expense, and then some. This one sounds obvious, but so many landlords miss deductions just because they're not tracking properly. You can claim for letting agent fees, mortgage interest, partially restricted for individuals but fully deductible for limited companies, repairs and maintenance, accountancy fees, travel costs for inspections, subscriptions to property websites or landlord associations. If you've got multiple properties, consider using software like Landlord Vision, Property Hawk, or QuickBooks Self-Employed to categorize everything. And if you run your rentals through a limited company, you can claim mortgage interest fully and pay only 19 to 25% corporation tax, instead of higher personal income tax rates. 8.2. The Section 24 hack, incorporation strategy. Back in 2017, the government removed full mortgage interest relief for individual landlords, known as Section 24. Since then, many landlords have switched to limited company ownership. Why? Because companies can still deduct 100% of mortgage interest as an expense. If you own more than 2 or 3 properties, it's often worth transferring them into a company, but this needs to be done carefully to avoid stamp duty and CGT triggers. Talk to a specialist tax advisor before doing it. Firms like GetGround or Property 118 Tax specialize in this exact thing and can structure it properly. It's not a quick fix, but it's one of those moves that can transform your long-term profitability. 8.3. Capital gains timing for property sales. If you're selling a buy-to-let or second home, remember that CGT is due within 60 days of the sale completion, not by the 31st of January like most other investments. But the smart move is to time your sale. Let's say you're close to the 5th of April tax year end. If you sell on the 4th of April, that gain counts for this tax year. Sell on the 6th of April, and it rolls into next year, effectively giving you up to 21 months before the tax is due. Timing alone can be a cash flow hack. 9. Crypto investors, the HMRC rules most people still don't understand. Now, let's talk crypto, because HMRC has been quietly tightening its grip here, and a lot of investors are in for a shock this January. Here's what you need to know. Crypto is taxed as capital gains, not income, unless you're trading frequently enough to count as a business, which is rare. So if you've sold Bitcoin, Ethereum, or even NFTs, those are all subject to CGT once you sell or swap them. Here's the part most people get wrong. You owe CGT even if you didn't cash out to fiat. Just swapping Bitcoin for Ethereum is a disposal event in HMRC's eyes. The tax hack? Tax loss harvesting again. If you've been sitting on red coins this year, you can sell them now to realize losses and offset those against any gains from other investments. Platforms like Coinly, CoinTracker, and Recap integrate with HMRC's format and make this process super simple. And if you've earned staking rewards or airdrops, those count as income, not capital gains, meaning you'll need to include them separately on your return. One pro tip here. If you're into DeFi or staking, move those assets into a separate wallet or account purely for tax tracking purposes. It makes record keeping so much easier when you file. 10. The HMRC self-assessment system, how to avoid costly mistakes. Every January, HMRC reports millions in late filing penalties and interest payments. Not because people don't have the money, but because they file late or make small mistakes. Here's how to stay clear. Register early. If you earned any untaxed income last year, dividends, crypto, property, freelance, you need to register for self-assessment by the 5th of October of that year. File online. Paper returns are ancient history. Online filing gives you until the 31st of January an instant calculation of what you owe. Use accounting software. FreeAgent, owned by NatWest, Tax Scouts, and Untied are great for individuals. They'll automatically plug into HMRC and flag missed deductions. Save for your tax bill throughout the year. Open a separate savings account, even something like Chip, Monzo Pots, or Revelup Vaults, and automatically save a percentage of your profits each month. That way, you're not scrambling in January. Claim every credit. Don't forget you can claim tax relief on things like pension contributions, charitable donations, and even certain professional subscriptions, CFA, accounting bodies, etc. These small moves add up. And they can make a serious difference when you're facing that final January calculation. 11. End-of-year tax planning before the 31st of January, your ultimate investor checklist. When January hits, most people panic. But the smart ones already did the groundwork. Here's your pre-31st January checklist. Think of it as your investor's tax survival kit. 1. Make sure every investment account is tracked. By now, you probably have multiple investment accounts, maybe one with Trading 212, another with Hargreaves Lansdowne, a crypto wallet, and maybe some dividend-paying shares through Interactive Investor. Each of those needs its own tax record. If you haven't already, get everything connected through a platform like MoneyHub or EmmaPro. These tools pull all your investment transactions into one dashboard, which makes calculating your total income and gains ridiculously easy. It's what I call tax visibility. Without it, you're guessing, and HMRC doesn't like guesswork. 2. Use the gift allowances strategically. If you have a spouse or civil partner, you're sitting on a hidden advantage, transferable allowances. You can gift investments between each other tax-free. You can also use each person's CGT, dividend, and ISA allowances separately. That means if one partner earns more and is in a higher tax band, you can shift certain income-producing assets to the other person to reduce your overall tax liability. And if one of you doesn't use their full personal allowance, £12,570, you can transfer up to 10% of it to the other under the marriage allowance. That's up to £252 saved per year. Small? Maybe. But these micro savings compound over time. 3. Top up your pension before the deadline. Remember, pension contributions made before the 5th of April can still reduce your tax bill due by the 31st of January. So, if you're looking at a high tax bill this year, you can make a pension top-up and claim the tax relief in this return. Providers like PensionBee, AJ Bell, and Interactive Investor allow quick lump sum payments that automatically claim 20% relief at source. If you're a higher rate taxpayer, you can claim the additional 20% through your self-assessment. For example, if you're a 40% taxpayer and you pay £8,000 into your pension, HMRC adds £2,000 automatically, that's the 20%, and you can claim another £2,000 through your return, meaning your £10,000 contribution only costs you £6,000. That's the kind of math that makes January feel a lot better. 4. Charitable donations for tax relief. This one's simple but powerful. When you donate through gift aid, charities can reclaim 25% of the donation, and higher rate taxpayers can reclaim the difference between the basic and higher rate. So if you've donated £1,000 through gift aid and you're a 40% taxpayer, you can reclaim £250 from HMRC. Keep those receipts, and if you give regularly through platforms like Just Giving or GoFundMe charity, download your annual summary before filing. 5. Check for carry-forward pension allowances. If you've not used your full £60,000 annual pension allowance in the past 3 years, you might be able to carry it forward and make a bigger contribution this year. For high earners, this is one of the most overlooked opportunities to claw back tax. Just check your annual allowance position through your provider or HMRC online account and top up before the 5th of April. Harvest losses now, don't wait. If you've got any losing investments, especially in crypto or volatile stocks, realize the losses before the 5th of April. Even if you plan to buy back later, doing it now locks in the loss so you can use it to offset 2024 gains. Losses carried forward have no expiry date, but if you forget to report them by the 31st of January, you lose the right to claim them later. That's one of the biggest mistakes HMRC sees, unclaimed losses from previous years. 6. Avoiding HMRC red flags that trigger audits. Let's be honest. Nobody wants that HMRC inquiry letter in their inbox. Here are the 5 red flags that get people audited. 7. Reporting round numbers too often. If your returns are full of tidy numbers like £10,000 or £2,000, it screams estimate. HMRC algorithms love that, in the worst way. Always round to the nearest pound. 8. Inconsistent income. If your dividend income or rental income suddenly disappears from one year to the next, HMRC's system will flag it, even if it's legitimate. Always leave a note in the additional information box explaining major changes. 9. Crypto emissions. HMRC now gets data directly from crypto exchanges like Coinbase, Binance, and Kraken. If you've sold or swapped crypto and don't declare it, you're on borrowed time. Use tools like Coinly or Recap to generate HMRC-compliant reports automatically. 10. Overseas income ignored. If you invest abroad, say through Interactive Brokers or eToro, those dividends and gains are still taxable in the UK, even if you left them in USD. Failing to include them is another audit trigger. 11. Last-minute filings. Statistically, late filings and those made in the last 72 hours before the deadline have the highest error rates, and they're flagged for review more often. File early if you can. 12. Smart tools and platforms every UK investor should use before January 31st. Let's be honest, nobody wants to manually track dividends, capital gains, and pensions with spreadsheets anymore. Here are the tools I genuinely think make a difference. The point isn't to use every tool, it's to automate enough that tax optimization becomes effortless. The investors who make the most money long-term aren't the ones chasing the next hot stock. They're the ones quietly maximizing every allowance, every year, without missing a beat. 13. The psychology of smart tax planning. Now, I want to take a step back, because tax efficiency isn't just about numbers. It's about mindset. Most people see tax as a punishment. But smart investors see it as a game, one with rules, and if you know those rules, you win. When you understand that the UK government literally rewards certain types of investing, ISAs, pensions, VCTs, EIS, and charitable giving, you start to build wealth within the system instead of fighting against it. That's why the wealthiest investors don't avoid tax, they engineer their finances to flow through reliefs and exemptions the system already offers. It's not dodging the rules. It's understanding them better than anyone else. Here's the truth, January 31st isn't a scary date if you prepare now. It's an opportunity to save money, not lose it. So before you close this video, here's what I recommend doing right now. Open or top up your ISA, use your £20,000 allowance before the 5th of April. Platforms like Moneyfarm, Hargreaves Lansdown, or Trading 212 make it instant. Log into your HMRC account, check if you've declared all income sources. It takes 2 minutes but could save you days of stress later. Use the link in the description to explore tools like Tax Scouts or FreeAgent. Both are game changers for simplifying your tax filing and staying compliant automatically. Schedule your pension top-up, even £100 now compounds massively over time, especially when you're getting up to 40% tax relief. Harvest losses, transfer assets, and plan before the year closes. Because at the end of the day, the tax code isn't your enemy. It's your instruction manual for building wealth smarter. And those who understand it, win. With that said, thanks for watching, and until next time, stay smart, stay disciplined, and make your money work harder than you do.